Hello, everyone. Hope you're doing well. Today, going to be explaining to you probably one of the most controversial financial terms, one that's divided opinions, and that is EBITDA. Um, so, EBITDA stands for earnings before interest, tax, depreciation, and amortization. Um, it's a way of evaluating a company's performance without sort of having to factor in sort of the financial decisions, accounting decisions, the current tax policies, and the current monetary environment. And sort of the reason why it matters is because it's often used by investors to assess a company's profitability. It sort of strips away all the complexities of accounting, and it can give a clearer picture of sort of the operational efficiency and ultimately the pure corporate profitability of a company. And so, because it removes the sort of any the current tax environment, the current interest rates, it allows you to compare the sort of financial situation of companies across different jurisdictions and across different sort of time periods. And you can go back in history and sort of compare the past performances. Because governments and policymakers and obviously different countries have varying tax laws and varying interest. We have obviously seen a massive rise in interest rates recently, but EBITDA gives you a sort of clear picture from a financial perspective of the company, regardless of the type of monetary or fiscal environment that the company is faced with. Now, to calculate EBITDA is actually quite simple. You start with the net income of the company, and then you add back the interest, the tax, the depreciation, and the amortization. And then what you're left with is the EBITDA value. Now, before I go through a quick example with you, I'm going to break down what all these components are and what they do. So obviously, you've got your interest. Now, this is just sort of the cost of borrowing. Sort of refers to the sort of expense a company incurs from borrowing money, including things like the cost of loans, or bonds, and other forms of sort of debt financing. We add this back, and it gives us the sort of operational performance of the company, independent of its sort of financial structure and its debt load. Taxes are obviously what a company pays on its earnings. They can include sort of your federal tax, your local tax. The rest sort of rationale behind this is to sort of assess the profitability without the sort of tax structure. These can obviously vary depending on what jurisdiction. So it sort of provides a clearer view of the overall performance, irrespective of the current tax policy and the tax rate that it's faced with. Depreciation is just simply the decrease in the value of the physical assets the company holds over time. Assets lose value, and and you normally take a specific percentage of the value of the asset per fiscal year. Amortization is similar, but this is for the sort of intangible assets, um, and it sort of refers to sort of the writing off of the sort of initial cost. These things it's very pretty much the same as depreciation, but it refers to sort of the non-physical assets such as patents or trademarks and things of that nature. And then you simply add all those onto the net income, and then you get the EBITDA value. So I'll run through an example with you here. Now, for this example, we've got two companies who operate in the same sector, let's say the technology sector, and they initially both have the same net income. Company A has a net income of 50 million. The interest is 5 million, tax 10, depreciation 4, amortization 1. Company B, same net income of 50, but the interest is 10, tax is 20, and then you've got 8 more in terms of the depreciation and the amortization. So when you add all those together, company A comes to 70 million of EBITDA, whereas company B gets to 88. So obviously you can see in both scenarios, the company operates sort of in the same sector, with the same net income. Otherwise, it would be quite hard to compare. this EBITDA value shows the sort of operational efficiency, and that B, it actually generates more earnings before the sort of accounting and the tax and the depreciation. And it sort of shows this can be very particularly useful for investors or analysts when comparing the profitability of two companies, sort of especially if you're considering making an investment in the company. This is really going to help you out. Now, this all sounds great, but there is massive controversy around EBITDA, because whilst it's useful, it's not a magic number, and it doesn't account for everything. It doesn't account for things like your capital expenditure, and it's not a true measure of the sort of cash flow of a business, and it can often mask the true financial situation of a company by you not including sort of the debt burden. It paints a rosier picture and rosier outlook of the actual company. And this is because it adds things like depreciation back on to simplify the analysis. And this, it sort of overlooks the facts that assets do wear out eventually, and they're eventually going to need replacing. And that replacing involves, a heavy amount of investment, and that's not factored in terms of the profitability, so it makes it look more profitable. But when you actually consider that a lot of that capital is going to have to go for further sort of capital replacement, then it obviously is a lot less profitable than it seems. And this is the same sort of principle for if a company that has a high turnover in terms of inventory, you're constantly going to need a high amount of capital in order to sort of maintain and expand the business. And the EBITDA value doesn't really reflect this at all. It doesn't reflect the significant investment that are necessary to sustain the business. And by masking the amount of capital you need, this also extends to sort of the debt levels. The EBITDA sort of doesn't expose the level of debt or financial troubles a company may be faced with. It paints a very optimistic view where you can sort of just ignore the debt levels. And yes, the earning may look great, but once you have to go and service the debt or replace the stock or replace the capital, then the financial health of the company is really not so great. And because of these limited sort of over reliance on EBITDA, it can potentially mislead investors to think the company is far more profitable, and it has a far more optimistic view than the actual situation once you factor in those costs. Two of the biggest critics of EBITDA are Warren Buffett and the late Charlie Munger. They've been very critical about the use of EBITDA as a financial metric. Buffett, has expressed his concerns with the use of it, pointing out that it sort of serves to embellish financial statements, and he's cautioned the use of it as a financial guide. And he's been quoted saying the number of times we're going to buy into a company where people are talking about EBITDA is roughly zero. This sort of highlights his skepticism around it, and highlights how he doesn't really use it when assessing the financial health of the company. The late Charlie Munger has been equally critical, if not more so, with regards to EBITDA. He famously stated in one of the Berkshire Hathaway annual meetings that it would be better if you substituted the word EBITDA for bullshit earnings. So this pretty much clearly states how he feels about EBITDA. He was obviously very openly critical of its adoption, and expressed that depreciation is a real cost. He expressed his disdain by saying, the idea that depreciation doesn't matter as crazy. You have to replace capital all the time. It's a real cost. So yeah, both Buffett and Munger criticize, highlights the sort of limitations of EBITDA, particularly when it comes to sort of the significant costs the company faces, such as depreciation and the sort of capital expenditure, and the real expenses of running a business. And these sort of comments from two of the finest investors we've ever seen sort of highlight and give a warning to investors to not rely too much on EBITDA as a sort of comprehensive and a realistic assessment of a company's performance, because it can mask so many different things when you start to really look in a deeper level of the actual company, especially when it comes to sort of the financial burden and of the debt levels, or the sort of replacement cost and capex of a company. But yeah, that's sort of EBITDA explained. Please let me know in the comments what your opinions on EBITDA are. Do you find it a useful way to understand and compare companies, or do you side more with Warren Buffett and Charlie Munger, and that EBITDA is completely useless? Let me know what you think. And if you found this video useful, please give it a like, and please let me know of any other financial phrases that you would like explaining. And yeah, enjoy the rest of your day, and I'll see you in the next video.